Despite official claims they weren't going to do this anymore, India's short dollar position soared yet again to a new record high as the country grapples with increasingly difficult challenges from basically all sides. In fact, the rupee's weakness is because of those economic fundamentals, the weakening and deteriorating fundamentals. So in many ways, the country's increasing short dollar position is essentially another indication of just how serious everything has become for what was, for a little while, the world's undisputed economic leader. And it's the same thing we keep encountering all over the world. Just a little slowdown, they say. Nothing to worry about. A red-hot economy that's moderating to a more stable, less inflation-y position. But then the currency plunges. GDP keeps coming in below expectations, as it did again yesterday for the latest quarter in India. The central bank has to keep intervening, not just externally in Forex, but also internally in terms of bank liquidity. The signs of an unhealthy situation continue to pile up one after another. And before you know it, the economy, which everyone said was moderating just a little bit, ends up forgetting how to grow, basically joining everyone else around the world, trying to make sense of all these conflicting signals, like plummeting currency that they all tell you is due to the Federal Reserve's policies. Only now, US interest rates are falling sharply too in recent days, and so are all these other currencies, only starting with India's. And don't forget, as I pointed out a couple weeks ago, India's central bank had conducted a massive intervention to stabilize the rupee, and that didn't even buy the currency 2 weeks before it went sharply lower all over again. Why? It's the fundamentals that matter. It's always the fundamentals. And even India is showing more signs of forgetting how to grow. And that's why the dollar has been on a rampage again more recently. It's the combination of what everybody's calling a growth scare plus the prospects for trade wars. What could happen to an already weakened global economy if tariffs add more negatives to it? And India's condition is more evidence for the first part of that, the weakened and weakening global economy. And as that weakening is more and more reflected in the rising US dollar exchange value against a whole bunch of currencies, including India's, central bankers are going to do what central bankers do, and that is intervene. And then after intervening, they're going to watch their intervention fail, and the fundamentals get repriced in all over again. But that's exactly what the Indians have been doing. They have been fighting against the stronger dollar, the higher Eurodollar premium, the higher risk premium for a global economy that keeps going in the wrong direction. Though the current incoming administration for the Reserve Bank of India under Sanjay Malhotra said, all the stuff that was going on under Das, we're going to change things up. But the latest data from the Reserve Bank of India showed it's the same thing because they don't really have any other alternative. What was reported is the Reserve Bank of India's net dollar short forwards position, the amount of dollars that will be sold at a future date for a preset price, hit an all-time high of $77.5 billion last month, that's the month of January, after rising to $68 billion in December, which is when Malhotra actually took over. Policymakers ramped up derivative bets last year to fend off strength in the greenback, but this approach raises the risk of losses. The Reserve Bank of India sold dollars heavily in the non-deliverable forward market since October, but has since shifted its intervention primarily to onshore in the current year, at least according to the traders that were sourced for this particular article. The RBI's net short position in maturities of up to 1 month stood at $20.9 billion, while that in tenors of more than 1 month up to 3 months accounted for $26 billion, at least according to the data that just came out. The exposure for contracts of more than 3 months, however, and going up to a year, totaled $30.6 billion and rising sharply from $9.9 billion in the previous month. And you can see what the Reserve Bank of India did here. They're terming out their interventions in the currency market, these derivatives, up to an entire year, hoping that by terming everything out, they don't add more negative pressures to the short-run conditions in the currency that's already weakening to begin with. So you push the maturities back out to as much as a year, hoping that basically everything kind of fixes itself between now and then. You're not adding more negative pressure, because as those short-term maturities come due, that means that you have to reverse the contract or even roll the contract, which can add more selling pressure to the local currency, making everything worse. So when confronted with these types of failures, central bankers, rather than rethink their strategy or really retool their strategy, will just push it further and further out into the future. They are really trying to kick the can down the road, and that doesn't work either. You see that in the currency. It was plummeting up until early February. February 7th, the Indian rupee against the US dollar fell all the way to 87.79, obviously a record low there. And then there were interventions that week totaling about $11 billion in the onshore marketplace. And that was enough to reverse the currency and get it stronger back all the way to 86.47 by February 20th. But that was it. So basically 2 weeks of relatively calm positions, a little bit of strength, a little bit of retracement in the currency. And then since the 20th, as trade wars have come back and the growth scare in the global economy, starting with the United States, has really hit the financial system all over the place. Now the currency's tanking again. And it's not just India's rupee, as I'll talk about a little bit later on in this video. But the rupee is down to 87.42 as of Friday, and the dollar spike continuing to project those fundamentals of India, but also India in combination with the growth scare that's growing around the rest of the world. Of course, it's not a growth scare, and it didn't come back. It's been there the entire time as the dollar has been projecting and pricing. Now interest rates are doing it, stock markets, other financial markets, and India is no different. Even though the economy seemed to be in a much different place, categorically different in 2023, as we saw last year, especially the second half of last year, it began to slow down too, raising the prospect that maybe India's economy, which was among the best performing, in fact, it was the best performing economy of all the major economies around the world, suddenly India might also forget how to grow too. That's why the dollar's up. That's why India is struggling so badly against the rupee that only goes in one direction. It's a complete change and a complete erasure of expectations. And these dollar interventions, the short dollar position, as well as all the other interventions the Reserve Bank of India has done, has created a liquidity problem locally in the local rupee market. Interbank markets are increasingly difficult because the Reserve Bank of India is doing everything in its power to take rupees out of it in order to intervene in these in the currency markets, to try to strengthen the rupee, but not having any success. So the Reserve Bank of India, they've been conducting a whole bunch of local liquidity operations to try to restore some semblance of liquidity in a situation that continues to get worse and worse and deteriorate there as well, because there are consequences, internal consequences to all of these external problems that all go back to the same thing, which is the fundamentals of the global economy and the risk perceptions of the dollar system operating within it. As much as there's problems outside of India, there are growing concerns from the inside as well. So you have the situation where the banking sector is looking at the same thing as the external sector is and coming to much the same conclusions. So the Reserve Bank of India is caught increasingly between a rock and a hard place, all because prospects and perceptions of the fundamentals continue to reverse. On Friday, the Indian government reported, well, what's for India, it's third quarter, but the October to December period, the fourth quarter around the Western world, but the third quarter GDP for India, which came in at 6.2% year over year. Now, that was faster than the alarmingly low 5.4% year over year change in India's second quarter, or the July to September quarter. But that 6.2% is not materially different from the 5.4% the previous quarter. It was well below expectations that the Reserve Bank of India had set of 6.8%. So the second straight quarter of a big miss to the Reserve Bank of India's projections. And even though economists were more realistic and somewhat more pessimistic, they were expecting 6.3% year-over-year growth and still underperformed economists. And remember, this is down from close to a 10% year-over-year rate in 2023. So as a result, the Reserve Bank of India has to cut its growth forecast for this year down to 6.6% from 7.2%. That was after the third quarter, or our third quarter, the India's second quarter. After the information we got from India's third quarter, they now say that they're thinking maybe they have to cut their growth expectation for the year that's almost over with to begin with to 6.5%. And just to meet that rate, India's got to really accelerate in the first quarter of this year, their fourth quarter. We're talking about close to 7.5%, 8% growth in the final quarter just to get to that 6.5% target, which is not really going to be all that likely. So the question here is, what's really happening in India? It's the same question that's been asked around the rest of the world. Are we seeing a red-hot economy that is simply moderating and slowing down to a more stable, less inflationary paradigm, a growth rate that's more suitable to the actual potential in the real economy? Or is this India, once the once the best growing economy amongst the major countries of the world, is it slowing down because it is now forgetting how to grow in line with the rest of these major economies around the rest of the world? Well, the IMF just came out with its Article 4 consultation from India just this past week as well, and they're more optimistic. They take the position that this is just a moderation, no big deal, just a slowdown to something more sustainable. In fact, they said, despite recent moderation, India's economic growth has remained robust, with GDP growth of 6% year over year in the first half of 24-25. Real GDP is expected to grow at 6.5% in the same year, and again next year, supported by what they call robust growth in private consumption on the back of sustained macroeconomic and financial stability. And you have to laugh at the last one because everything that we've talked about in the first part of this video is the opposite of financial stability. If anything, it's financial instability that continues to get worse. The fact that they're still having to grow, still having to intervene in the local currency markets as well as the foreign currency markets tells you that there isn't financial stability. If there was financial stability, there would have been some interventions earlier in the year, but they continue to have to do it week after week after week, month after month after month. Financial stability, that's not what's happening in India at all. But going back to the IMF, but the risks to the economic outlook, they admit, are tilted to the downside. Deepening geoeconomic fragmentation could affect external demand, which is another way of saying growth scare, the dynamics of the growth scare on the entire global economy, while deepening regional conflicts could result in oil price volatility, weighing on India's fiscal position. Domestically, the recovery in private consumption and investment may be weaker than expected if real incomes do not recover sufficiently. That's another one that we've talked about before too. In every place around the world, be it Europe or Australia or everywhere in between, they keep saying, we expect consumption to support the economy as it slows down because as consumer price rates fall, consumers have more purchasing power. At least that's the idea. And therefore, they'll spend more in real terms, and that will continue to support the economy and support this moderation of growth and keep it from becoming anything more than that. And in place after place, in jurisdiction after jurisdiction, country after country, part of global economy after part of the global economy, it fails. Instead, what's supposed to support the economy and keep it in nothing more than moderating from a red-hot period, instead turns into forgot how to grow. And that's the danger that we see in India. The thing is, India has been here before. We've been here before looking at India, watching everyone ignore the signals coming from the currency exchange, the Indian rupee going lower, and just making the same conclusions anyway. In 2018, heading into 2019, the IMF in particular, and it wasn't just the IMF, everybody around the mainstream said the same thing. They saw the Indian rupee collapse pretty substantially, but then ignored that signal and said, well, India's just slowing down a little bit. In fact, here's from the IMF in August of 2018. They actually said, India's economy is picking up and growth prospects look bright, partly thanks to the implementation of recent policies, such as the nationwide goods and services tax. As one of the world's fastest growing economies, accounting for about 15% of global growth, by the way, that's the reason why we pay so much attention to India, India's economy has helped to lift millions out of poverty. India's economy is gaining momentum thanks to the implementation of several recent noteworthy policies, such as the enactment of long-awaited goods and services tax and the country opening up to more foreign investors. Therefore, we expect economic growth to pick up to about 7.3% for fiscal year 2018-2019. And it did not pick up. The future was not bright. In fact, India was heading into its own version of pre-COVID recession, the same as the rest of the global economy. In fact, India was contributing to the global pre-COVID recession, contributing quite a bit to it since it accounts for so much of global growth to begin with. By the fourth quarter of 2019, no momentum, no acceleration, no bright future. GDP was growing at 3.3% year over year. That's how much it has slowed down. We also saw a number of indications that suggested that India was getting into real trouble before we got to 2020. Industrial production had turned negative for the first time since the 2008-2009 global Great Not Recession. So everyone that thought the Indian economy was moderating in 2018 heading into 2019, just a little bit of a slowdown, no big deal, they missed all of the signals that said this wasn't just a slowdown. In fact, India by 2019 had by using the terms that we have here, forgot how to grow. And since we're on the topic of the US dollar and its exchange value, really the disruption that exchange value represents in the Eurodollar system, there's been chatter and rumors of a Mar-a-lago accord that the Trump administration is pursuing. And that's something, if you're interested, I talked about with Eric Townsend, our old buddy from MacroVoices. Did an extensive interview on the potential behind a Mar-a-lago accord, what might be in it, what we can tell thus far, what it actually represents, would it succeed, what are its goals. Did all that in an interview with Eric Townsend at MacroVoices. There's a link in the description of this video if you want to get to that. And also we'll be doing a follow-up video on the Mar-a-lago Accords and some of the nitty-gritty details that go along with that. So check out Eurodollar University's website for more information on both the MacroVoices interview along with the presentation, the full presentation and all the details. As I said, there's a link in the description below as well as at Eurodollar University's website, eurodollar.university. And if it was just this one country, and I keep saying that with every country that comes up that we focus on here on Eurodollar University in our channel, if it was just India, if it was just Europe, if it was just Mexico, if it was just, you see the theme here, it's one after another after another. And so the problem is that it's not just one place or another, it's everywhere. We see that in the US dollar exchange value. So the rupee continues to be weaker and weaker and weaker no matter what the Reserve Bank of India does, whether intervening directly, intervening in derivatives, shorting the hell out of the dollar, doesn't matter. The dollar continues to go higher, these other currencies lower because of fundamentals, the fundamentals of what everybody's calling now a growth scare that have been there this entire time. So in addition to India's rupee, you know, something like the Australian dollar that I talked about a couple weeks ago. The Aussie dollar was a little bit stronger as some fears of trade war started to recede. But then over the last week, really going back to the same date, February 20th as the Indian rupee, the Australian dollar is weaker. It's down to around its recent low, which was a multi-year low, the lowest since 2020. In fact, the Aussie dollar is still in the same territory, among the weakest exchange values for Australia of the entire 21st century. And that's despite the fact that the central bank there only just got to its first rate cut of this entire cycle. And according to the central bankers themselves in Australia, they don't plan on going any faster. So by mainstream accounts, the Australian dollar should be strengthening here because central bank policy differentials are definitely in the Reserve Bank of Australia's favor. But it's not central bank policies. That's the point we keep making. It doesn't matter what the central banks are doing, whether it relates to the currency or not. It's the fundamentals that drive the dollar, which is why the Australian dollar corresponds with so many others, including China's yuan. And China's yuan is moving lower all over again in the same period since February 20th. China's got a whole bunch of problems that it has to deal with related to the same growth scare, forgot how to grow economy. Starting with a banking system that the authorities in China just decided they needed to bail out, as well as there's a tremendous amount of illiquidity in money markets in China that I've talked about pretty extensively recently in Eurodollar University's deep dive analysis. So check out the Eurodollar University deep dive analysis to stay abreast of all of these serious concerns that are going on in China as well as in India and the banking system there. New Zealand's dollar. New Zealand is in a more traditional recession. It's got massively rising unemployment. So, of course, the New Zealand dollar is getting weaker, but it's getting weaker in the same way as the Australian dollar or Korea's won. There's a good correlation between the Australian dollar, the New Zealand dollar, South Korea's won, China's yuan, because it all goes back to the dollar fundamentals that are not about central bank policies or central bank interventions. It's about the growth scare. It's about economies around the world that are not just moderating from a period of red hot economics, they are forgetting how to grow. Many of them have forgot how to grow for the last couple of years. Now we're seeing countries like Australia starting to forget how to grow, and maybe even India too. So is India moderating or is it forgetting how to grow? Well, we know what the market's verdict is. That's why the dollar continues to go up, and that's why the exchange value of all of these countries, not just India's, continues to go lower. Even the IMF said that the risks are tilted to the downside. They want to admit that it's an economy that's gone way past moderating, but they even have to admit the downside risks are there because it's emerging in all the recent economic data as well. The dollar goes up because of fundamentals, and the fundamentals are going where all these other currencies against the dollar are, which is a lot lower. Yes, the Reserve Bank of Australia has joined the global rate cutting cycle, the globally synchronized US dollar against the Australian dollar and all the rest of them. And I went over the details behind those in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.